Most people think businesses fail because of bad ideas. But the truth is, businesses fail because owners don't understand money. In this video series, I will explain the 30 most important finance basics every business owner must know. If you skip this, you will pay for it later, with your money, your time, and your stress. Cash flow is the lifeline of any business. It simply means how money moves into and out of your business. Many people confuse cash flow with profit, but they are not the same thing. A business can look profitable on paper and still shut down if it runs out of cash. Cash flow focuses on timing, when money comes in and when it goes out. Imagine you run a small business. You sell products worth $10,000 in 1 month, but your customers will pay you after 60 days. Meanwhile, you must pay rent, salaries, electricity, and suppliers right now. Even though you made sales, you may not have enough cash to survive. This is where cash flow problems destroy businesses. Positive cash flow means more money is coming in than going out. Negative cash flow means expenses are higher than income during that time. Smart business owners track cash flow weekly or monthly, not yearly. They plan payments, delay unnecessary expenses, and speed up collections from customers. Cash flow also affects growth. If your cash is stuck in unpaid invoices, you can't invest in marketing, staff, or equipment. That's why many successful businesses focus more on cash flow than profit in the early stages. In simple words, profit is theory, cash flow is reality. If cash stops moving, the business stops breathing. Revenue is the total money your business earns from selling products or services before any expenses are deducted. It is also called top-line income. Revenue shows how big your business activity is, but it does not show how healthy the business is. Many beginners make the mistake of chasing high revenue without caring about costs. A business earning $100,000 in revenue can still lose money if expenses are $110,000. That's why revenue alone does not mean success. Revenue comes from different sources, such as product sales, services, subscriptions, or commissions. Smart businesses diversify revenue streams so they are not dependent on just one source. Tracking revenue helps owners understand customer demand, pricing power, and growth trends. If revenue is increasing but profit is falling, it means costs are rising too fast. If revenue is flat, it signals a need for better marketing or new offers. For YouTube creators, freelancers, or online businesses, revenue could be ad income, client payments, or digital product sales. Knowing your monthly and yearly revenue helps you plan taxes, expenses, and expansion. Revenue answers one simple question: how much money is the business bringing in? Net profit is the final money left after all expenses are paid: rent, salaries, marketing, taxes, interest, everything. This is the real indicator of business success. Net profit shows whether your hard work is actually paying off. A business with high revenue but low net profit is running inefficiently. A business with moderate revenue and strong net profit is healthy. Net profit can be reinvested, saved, or distributed as dividends. It is also what investors and banks look at when judging a business. Tracking net profit monthly helps owners catch problems early. If profits are shrinking, costs must be controlled or prices adjusted. In simple terms, revenue feeds the business, but net profit rewards the owner. A balance sheet is a financial snapshot of a business at a specific moment. It shows what the business owns, what it owes, and what belongs to the owner. It has 3 parts: assets, liabilities, and equity. The balance sheet follows one golden rule: assets equal liabilities plus equity. This statement helps owners understand financial stability. If liabilities grow faster than assets, the business becomes risky. If equity increases over time, the business is building real value. Balance sheets are important for loans, investors, and long-term planning. They show whether the business is standing on strong financial ground or weak foundations. Assets are everything a business owns that has value. They're the tools, resources, and financial power that help a business operate and grow. Without assets, a business cannot produce, sell, or earn. Assets are not just physical items. They can also be financial or intangible. Assets are usually divided into current assets and non-current assets. Current assets are things that can be converted into cash within 1 year, such as cash itself, bank balances, inventory, and accounts receivable. Non-current assets are long-term items like buildings, machinery, vehicles, computers, and equipment that are used for many years. Assets represent strength. When a business owns strong assets, it becomes more stable and trustworthy. Banks are more willing to give loans, investors feel safer, and growth becomes easier. However, owning assets also comes with responsibility, maintenance, depreciation, and proper use. Many beginners make the mistake of buying assets emotionally instead of strategically. Buying expensive equipment that is rarely used can hurt cash flow. Smart business owners ask one question before buying any asset. Will this asset help me earn more money or save time? Digital businesses also have assets. Websites, software, online courses, intellectual property, and brand value are powerful intangible assets. They may not be visible, but they generate income for years. In simple words, assets are the foundation of a business. The quality of assets often determines how fast and how safely a business can grow. Liabilities are everything a business owes to others. This includes loans, unpaid bills, supplier payments, taxes, salaries payable, and any future financial obligations. Liabilities are not always bad, but unmanaged liabilities can destroy a business. Like assets, liabilities are divided into current liabilities and long-term liabilities. Current liabilities are due within 1 year, such as rent, utilities, accounts payable, and short-term loans. Long-term liabilities include bank loans, mortgages, and long-term financing. Debt can be useful if it helps a business grow faster, such as buying equipment or expanding operations. But debt becomes dangerous when revenue cannot cover repayments. Many businesses collapse not because they are unprofitable, but because liabilities pile up faster than income. Smart business owners track liabilities carefully. They know exactly how much they owe, when payments are due, and how interest affects total cost. Ignoring liabilities creates stress, penalties, and damaged relationships with suppliers and lenders. Liabilities must always be compared with assets. If liabilities are higher than assets, the business is technically weak. If liabilities are controlled and supported by strong assets, the business remains healthy. In simple terms, liabilities are promises to pay money in the future. If those promises become too big, they can suffocate the business. Equity represents the owner's true ownership in the business. It is what remains after all liabilities are subtracted from assets. Equity shows how much of the business actually belongs to the owner or shareholders. The formula is simple. Equity equals assets minus liabilities. Equity grows when a business makes profits and reinvests them instead of spending everything. It also increases when owners invest more money into the business. Strong equity means the business has real value beyond daily operations. Investors focus heavily on equity. A business with growing equity is attractive because it shows long-term sustainability. Banks also look at equity to judge how risky it is to give loans. Negative equity is a warning sign. It means liabilities are greater than assets. Many businesses continue operating in this state without realizing they are financially sinking. For small business owners, equity is personal wealth tied to the business. Every smart decision that increases profit, controls costs, and reduces unnecessary debt increases equity. In simple words, equity is the financial reward of patience, discipline, and smart management. Accounts receivable is the money customers owe your business for products or services already delivered. This is sales made on credit. While it counts as revenue, it is not cash yet. Accounts receivable is one of the biggest reasons businesses face cash flow problems. Sales look strong, but money is stuck with customers. Bills must still be paid, even if customers delay payments. Smart businesses manage receivables aggressively. They set clear payment terms, send invoices on time, and follow up consistently. Some businesses offer discounts for early payments and penalties for late payments. Long collection periods weaken a business. If customers take 60 or 90 days to pay, cash flow becomes unstable. Strong businesses aim to shorten this cycle as much as possible. Accounts receivable should always be reviewed. Old, unpaid invoices may turn into bad debts, money that will never be collected. In simple words, accounts receivable is your money sitting in someone else's pocket. The faster you collect it, the stronger your business becomes. Accounts payable is the money your business owes to suppliers or vendors. This includes unpaid invoices for goods, services, rent, utilities, or materials purchased on credit. Managing accounts payable correctly helps maintain cash flow. Paying too quickly can drain cash, while paying too late damages trust and reputation. Smart businesses balance timing carefully. Suppliers are partners. When accounts payable is handled professionally, suppliers may offer better terms, discounts, or priority service. Poor payment behavior can result in higher prices or supply disruptions. Accounts payable is also a source of short-term financing. Using credit wisely allows businesses to operate without immediate cash outflow. However, relying too much on unpaid bills creates hidden pressure. Every business should know how much it owes, to whom, when payment is due. In simple terms, accounts payable is controlled borrowing. Managed well, it supports growth. Managed badly, it creates chaos. Dividends are the portion of profit that a business pays to its shareholders or owners. Not every business pays dividends, especially in the early stages. Many growing businesses choose to reinvest profits back into the company instead of distributing them. Understanding dividends is important because they represent how profits are shared, not just earned. When a business makes a profit, the owner has two choices: reinvest the money to grow faster, or take some of it out as dividends. Mature companies with stable income often pay dividends regularly because they don't need to reinvest all profits for growth. Startups and small businesses usually avoid dividends to strengthen cash flow and equity. Dividends also signal financial health. A company that consistently pays dividends is usually stable and profitable. However, paying dividends without enough cash can be dangerous. Profit on paper does not always mean cash in hand. That's why dividends should be paid only after ensuring strong cash flow. For business owners, dividends are personal income, but smart owners do not drain their business. Excessive dividend payments can weaken working capital and slow growth. Balance is key. In simple terms, dividends are the reward of ownership, but only healthy businesses can afford them consistently. Depreciation is the reduction in value of physical assets over time due to usage, wear and tear, or aging. Assets like machines, vehicles, computers, and furniture do not last forever. Depreciation recognizes this loss of value gradually instead of all at once. From an accounting perspective, depreciation spreads the cost of an asset over its useful life. For example, if a machine costs $10,000 and lasts 10 years, depreciation expense may be $1,000 per year. This gives a more realistic picture of profit. Depreciation also reduces taxable income, which helps businesses legally lower taxes. However, depreciation is a non-cash expense. It reduces profit but does not reduce actual cash. That's why businesses must separate accounting profit from cash flow. Many beginners ignore depreciation and then get shocked when assets need replacement. Smart businesses plan ahead, setting aside cash for future upgrades or repairs. In simple words, depreciation reminds business owners that assets slowly lose value, and planning for replacement is essential for long-term survival. Amortization is similar to depreciation, but it applies to intangible assets instead of physical ones. Intangible assets include software, licenses, patents, trademarks, copyrights, and goodwill. These assets also lose value over time, even though you cannot physically see them. For example, if a company buys software for $5,000 with a useful life of 5 years, it may amortize $1,000 per year. This spreads the cost evenly and reflects the real economic benefit over time. Amortization helps businesses avoid showing high expenses in one year and low expenses in others. It improves financial clarity and consistency. Like depreciation, amortization is a non-cash expense. Digital businesses rely heavily on amortization. Websites, apps, online platforms, and digital tools are major assets. Ignoring amortization can make profits look misleadingly high. In simple terms, amortization is the gradual cost recognition of invisible assets that still generate real money. Financial ratios are powerful tools used to analyze business performance. They convert raw financial data into meaningful insights. Ratios help owners, investors, and lenders quickly understand strengths and weaknesses. There are different types of ratios: profitability ratios, liquidity ratios, leverage ratios, efficiency ratios. Ratios help compare performance over time and against competitors. For example, a declining profit margin may indicate rising costs or pricing problems. A high debt ratio may signal financial risk. Ratios turn numbers into stories. They answer questions like, is the business profitable? Can it pay short-term bills? Is it overusing debt? In simple words, financial ratios are the health report of a business. Risk management is the process of identifying, analyzing, and controlling financial risks. Every business faces risks: market changes, customer loss, economic downturns, fraud, or unexpected expenses. Ignoring risk does not remove it. Managing it does. Good risk management starts with awareness. Business owners must ask, what can go wrong? Then they prepare strategies to reduce damage. This may include insurance, diversification, emergency funds, and strong internal controls. For example, relying on one big client is risky. Losing that client could destroy the business. Diversifying customers reduces this risk. Keeping emergency cash protects against sudden crises. Risk management is not fear, it is preparation. Businesses that survive long-term are not the luckiest, they are the most prepared. In simple terms, risk management is planning for problems before they arrive. Tax planning means legally organizing your finances to reduce tax burden. It is not about hiding income or doing anything illegal. Smart tax planning helps businesses keep more of their hard-earned money while staying compliant with the law. Many small business owners fear taxes because they don't understand them. In reality, taxes become manageable when planned early. Expenses such as rent, salaries, utilities, software, depreciation, and business travel can often be deducted. Without planning, owners miss these benefits and overpay taxes. Tax planning also improves cash flow. Paying taxes suddenly without preparation can shock a business. Smart businesses set aside money monthly and use tax calendars to avoid penalties. Another key part of tax planning is choosing the right business structure. Sole proprietors, partnerships, and companies are taxed differently. The right structure can save significant money over time. In simple words, tax planning is paying what you owe. Nothing more, nothing less.
Debt management is about using borrowed money wisely. Debt itself is not bad. When used correctly, it helps businesses grow faster. When used carelessly, it becomes a trap. Good debt helps generate income, such as loans for equipment, inventory, or expansion. Bad debt comes with high interest and no clear return. Smart businesses always ask, will this debt help me earn more than it costs? Managing debt includes tracking interest rates, repayment schedules, and total obligations. Missing payments damages credit score and reputation. Too much debt creates pressure and reduces flexibility. Successful businesses keep debt under control and ensure profits can comfortably cover repayments. In simple terms, debt management is making sure debt works for you, not against you. Capital structure explains how a business is funded, through debt, equity, or a mix of both. Equity is owner or investor money. Debt is borrowed money that must be repaid. A business funded only by debt is risky. A business funded only by equity may grow slowly. The right balance depends on industry, stability, and growth goals. Debt is cheaper but risky. Equity is safer but expensive because ownership is shared. Smart businesses adjust capital structure as they grow. Investors and banks analyze capital structure to judge risk. A healthy structure builds trust and stability. In simple words, capital structure is how you fuel your business engine. Investment strategy means deciding where to put money to grow the business. Every dollar invested should have a purpose. Smart investments improve productivity, sales, or efficiency, like marketing, technology, training, or product development. Poor investments waste cash and slow growth. Good strategy focuses on long-term returns, not short-term excitement. Businesses that reinvest profits wisely grow faster and stronger. Accrual accounting records income and expenses when they occur, not when cash moves. This gives a more accurate picture of business performance. For example, if you complete a service today but get paid next month, accrual accounting records revenue today. This helps match income with expenses. Most growing businesses use accrual accounting because it shows real profitability. Cash accounting is simpler but can be misleading. In simple words, accrual accounting shows what is truly happening in the business. A budget is a financial roadmap that shows how much money a business expects to earn and how it plans to spend it. Without a budget, businesses operate blindly. With a budget, every decision becomes clearer and more controlled. Budgets help prevent overspending. They force business owners to plan expenses before money is spent. This includes rent, salaries, marketing, utilities, tools, and unexpected costs. When expenses are planned, cash flow becomes stable. A good budget is not rigid. It is flexible and reviewed regularly. If revenue increases, budgets can be adjusted. If revenue falls, spending must be controlled quickly. Businesses that review budgets monthly survive longer than those who don't. Budgets also help set financial goals. Owners can plan savings, investments, and growth targets. Instead of reacting to problems, budgets allow proactive management. In simple terms, a budget is telling your money where to go, instead of wondering where it went. Revenue recognition is about recording income at the correct time. Revenue is recognized when it is earned, not necessarily when cash is received. This principle ensures financial statements are accurate and honest. For example, if a business delivers a service today, but gets paid next month, revenue is recorded today. This helps match income with related expenses, giving a true picture of performance. Incorrect revenue recognition can inflate profits and mislead owners. It can also create tax and legal issues. That's why clear policies are important. For subscription-based and service businesses, revenue recognition becomes especially critical. Income must be spread over the service period. In simple words, revenue recognition answers the question, when did we actually earn this money? A cash flow statement shows how cash moves in and out of a business over a period. Unlike profit reports, it focuses only on actual cash. It has 3 sections: operating activities, investing activities, financing activities. This statement helps owners understand liquidity, whether the business can survive short-term obligations. Many profitable businesses fail because they ignore cash flow statements. By reviewing this statement regularly, owners can spot problems early, such as slow collections or excessive spending. In simple terms, the cash flow statement shows whether your business can breathe financially. Internal controls are systems and procedures designed to protect a business from errors, fraud, and misuse of funds. They ensure accuracy and accountability. Examples include approval processes, separation of duties, regular audits, and secure access to financial data. Even small businesses need basic controls. Without controls, businesses become vulnerable. With controls, trust and efficiency increase. In simple terms, internal controls are the safety locks of your business finances. The working capital cycle shows how quickly a business turns inventory and sales into cash. It measures the time between paying for inventory and receiving cash from customers. A shorter cycle means faster cash recovery and stronger liquidity. A longer cycle means cash is stuck in inventory or unpaid invoices. Businesses with slow cycles often face cash shortages. Improving the working capital cycle involves managing inventory efficiently, collecting payments faster, and negotiating better payment terms with suppliers. In simple terms, the working capital cycle shows how fast money moves through your business. The debt-to-equity ratio compares borrowed money to owner's investment. It shows how much of the business is funded by debt versus equity. Formula: debt to equity equals total debt equity. A high ratio means higher risk. A low ratio means financial stability. Investors and banks use this ratio to judge risk before lending or investing. In simple words, this ratio shows how balanced your financing is. Working capital is the difference between current assets and current liabilities. It shows whether a business can pay its short-term obligations. Formula: working capital equals current assets, current liabilities positive. Working capital means the business can survive short-term challenges. Negative working capital means danger. Strong working capital allows smooth operations, timely payments, and growth. In simple words, working capital is your business's short-term safety net. The break-even point is where total revenue equals total expenses. At this point, the business makes no profit and no loss. Knowing the break-even point helps owners set sales targets and pricing strategies. It answers a simple but powerful question: how much must we sell to survive? Lowering costs or increasing prices reduces the break-even point, making the business safer. In simple words, break-even point is the line between survival and profit. If this video helped you understand money better, hit the like button. Subscribe to this channel for more simple, powerful business knowledge. And comment below which finance topic confused you the most.